All right, hello. Today we are doing. This is episode 5. I think we're doing PD arrays part 2, which is fair value gaps. Last episode we did order blocks, and today we're on fair value gaps. It's essentially a very similar idea. You just want to fair value gaps are an area where the institutions want to buy from if it's bullish or sell from if it's bearish, but it's a discounted level where the institutions want to drive price towards before continuing with the overall trend because they want to get the best price they can to enter off before continuing upwards. Right, so a fair value gap is fairly easy to spot. We'll go on the daily here. I'll show you an example of a fair value gap. So a bullish fair value gap, I would make notes here, but it's quite simple. So when you're drawing out fair value gaps, you use your rectangle tool on TradingView, which I showed you in episode 2, I think. So for a bullish fair value gap, it is literally just a gap in price. So there's 3 candles to a fair value gap. The first candle, the second or middle candle, and the third candle. To spot a fair value gap, the high of the first candle, which is here, and the low of the third candle, which is here, remember the structure of a candle from episode 1, there's got to be a gap in between, and now you can see here there's quite an obvious gap. So high of the first candle, low of the third candle, and you just connect them up like that with your rectangle tool, and there you go. That is a fair value gap. That's how you draw one. That's how you see a bullish one. So here we're on the 4-hour time frame. Remember I said higher the time frame, higher the power. We're quite clearly in a bullish trend, and here we've got a pretty big 4-hour fair value gap. It by the way, it doesn't matter what colour the candlesticks are as long as this gap is here. So the first candle, the high of the first candle, I'll draw lines out here. So this is the high of the first candle, there. This is the middle candle, and this is the low of the third candle. So, there. So this gap here represents an imbalance in price. So what is price likely to do? Price is likely to return back to the area to rebalance price so the institutions can get a discounted entry before continuing the uptrend. So as you can see, we'll draw the gap. The top of the first to the bottom of the third candle. I'll delete these lines. So this, I think I deleted all of it then. So that's our bullish fair value gap, and we want to see price do sort of, where is it? We want to see price do sort of a tap into it and then continue up. Oh, fucking hell. You can tell I'm not really good with the path tool. So you want to see price tap into the fair value gap and then sort of continue up like that. So let's see what happened. Yep. And there you go. So didn't happen exactly like that, but never does. But as you can see, the gap was formed. The institutions wanted to continue the uptrend because we are bullish at the moment, mostly due to news and just we're in a massive bullish uptrend, going to take all-time highs in NQ. So you can see the gap being formed, and remember it's a 4-hour gap. as well. So inside of this gap, there's going to be a lot of liquidity. Don't worry about that too much yet. We're going to go over liquidity on the episode after next. So as you can see, a bullish fair value gap. Price comes up, leaves a gap in price. So price returns back down to it, fills it, and then continues up. Let's do a bearish example. For bearish, I might have to go to a lower time frame. Yeah, that's one. Right, so for a bearish candle, it's exactly the same, but obviously vice versa. So here you can see we've got a bearish fair value gap here, but the one we'd want to pay attention to would be this one. Well, this is just a random one, but it's a good example. So for bearish, you can pick any candle where there's a gap. It doesn't necessarily matter as long as there's a gap there, because the gaps that you choose, they will have to be aligned with something in order for you to take an actual trade off them. Because remember, this is just the basics. So for bearish, the bottom of the third candle, which is the bottom of the first candle, the bottom of the first candle, which is here, first candle here, and the top of the third candle, which is here. So as you can see, this three candle formation here. You draw your rectangle in the gap, and then there you go. Price tapped into the fair value gap, and then rejected off it, and continued lower.